For our next session, we'll focus on mobilizing investors through capital markets with a focus on institutional investors. This session will feature a presentation by Mr. Mark Davis, Senior Financial Sector Specialist at the World Bank. Following the presentation, we'll have a panel discussion with the following distinguished panels: Mr. Mark Davis, Mr. Farai Sambo, Financial Officer at the IFC Treasury, Mr. Siongo Kisoso, Managing Director at BK Capital Rwanda, and Mr. Leonard Mathu, Managing Director at AIS Capital Advisors. This session will be moderated by Mr. Assefa Sumoro, Senior Advisor at the Ethiopian Capital Market Authority. Please welcome Mr. Davis to the stage. Thank you.
Good afternoon. I was watching the time. I was assuming we'd go to lunch and then I'd speak, and that would have been a different challenge, but now I stand between you and lunch, so I'll give it my best shot. So we're going to talk about institutional investors here in just a minute as a panel, but I'm going to share a couple thoughts about how to grow the institutional investor community at the bank, or not at the bank, but in Ethiopia. So it's obvious that a greater institutional investor presence is needed here. We've talked a lot about quite a bit of retail investors, but that the institutional investor community is largely not a major force at all. So my focus at the World Bank is on pension funds. So I work with Social Security funds, I work with private pension funds around the world. So I want to talk about both pension funds and insurance companies as some of the premier institutional investors that you usually find in a robust capital market. Pension funds have over 56 trillion of investments around the world, and insurance companies have about 6 trillion. So they're incredibly sizable forces that do a lot of investment around the world. Patient capital that was mentioned earlier, that's the epitome of what pension funds are. If they're doing their job correctly, because usually they have long duration liabilities. Insurance companies, especially life insurance companies, also can provide that kind of patient capital that is going to be very helpful. They'll be a little bit more conservative typically than the pension funds, but they will provide a great base of investment for an economy. One thing I like to say pretty early on when we start talking about pension funds as just a yet another kind of investment source is that pension funds actually have a primary duty, which is to their participants. So their first job is to provide retirement security to their participants. So I love the idea of pension funds as patient capital and as great providers of investment for things like infrastructure. They're a perfect match. But they need to do their first job, which is to provide retirement security for participants, and they need to have strong governance so that their decision makers can make sure they're doing that job well. So just with that key caveat, I would say, don't think about them as just yet another development bank. They're different, but yet they can do their job for their participants who have an expectation of receiving a pension promise in 30 years, and they can invest in things that I think are going to be very helpful for the economy. Because they're looking for this kind of long-term, high reward, slightly higher risk in types of investments. They have the ability to endure illiquidity. They have the ability to endure lower levels of certainty in the near term. So they're a perfect match with equity, really, especially as you start talking about listed equity, even unlisted equity. They can make those kind of investments, and it will be fine. I mentioned my caution about letting the pension funds do their first job, but I also want to mention the fact that just about a year ago, I co-authored a publication from the bank on how to harness local investors, the case of pension funds. So I'll say the one thing, but then immediately I'll proceed to the other, which is they're a really helpful source of funding. I also want to link to something that my colleague Zolt said yesterday about foreign investors. So foreign investors are great, but they will flee at the first sign of trouble, as Zolt mentioned. Whereas a local currency pension fund and a local currency long-term insurance companies, they're going to be more apt to stay for the long term because again, ideally, their promises that they've made are promises 20 and 30 years in the future, so they can endure the short-term volatility, especially if they have strong governance and if they're not being judged on an every year basis, which is inappropriate for the pension funds and the insurance companies. Because of that, again, they're also going to be counter-cyclical. So they're going to be the ones who are looking at a certain situation, and maybe today's news is particularly frightening, but they take a step back and they have high caliber kind of decision makers in their governing board, and they're able to make a decision that they're going to stay in a given investment because they believe the long-term prospects are actually quite promising. And so they're going to be not jumping out at the first sign of trouble, which is the problem with retail investors. So retail investors are going to be very volatile, and you don't want them to be leading the market sentiment. You want these stable kind of professionals to be leading market sentiment when at all possible, and pension funds and insurance companies can do that. Another thing I wanted to talk about is risk and volatility. So one of my favorite charts as I work with clients and counterparts is showing risk plotted in two ways and showing prospective return plotted in two ways. One on a 1-year basis and one on a 20-year basis. So showing the x-axis, let's say, with 1-year volatility and the y-axis with 20-year volatility, it shows a very different picture. Because I work with lots of counterparts who have just investments that are very conservative, but yet they've made a 20 or 30-year promise to a number of participants. So if you look at things in 1-year terms, yes, it's going to be scary to be in infrastructure investment, or yes, it's going to be scary to be in unlisted equity. But if you look on a 20-year basis, as an example, in the U.S. where you have long databases that have all sorts of years of data, and you evaluate 20-year rolling returns, the risk, quote, of an equity investment is actually very minimal. It's extremely hard to find a 20-year period in which equity actually declined in the U.S. databases. So when you look on a 20-year basis, equity all of a sudden looks very promising because you can find actually a decent number of double-digit returns in those 20-year return streams. Whereas on a 1-year basis, T-bills will look fine, but you're not going to do really any better than the 2 or 3% that perhaps you're going to see in that 1-year time frame on a consistent basis anyway. So certainly less risk on a 1-year basis, but all sorts of opportunity costs on a 20-year basis. So just something to think about is how do we talk about risk? So how do we develop institutional investors more consistently? One of the things I was thinking about is you have a couple funds that already exist here, pension funds, the Public Service Pension Fund, the Private Organization Employees Fund. Their investment strategies are pretty simple and limited right now, is my understanding. So how do we develop capability in the investment organizations for those funds? How do we kind of bring them additional latitude around what they can invest in once they have the capability to do it? Perhaps they should be encouraged to add some mandates that would require outsourcing some of the investments to external managers. But let's begin with what exists already. Secondly, let's lay a foundation for attracting more private sector pension funds. So this is hard to do. I'm just going to say that out right at the outset, because unless you mandate it, it's hard to start the momentum for voluntary pensions. But if you think about where the journey could begin with supplementary pensions, you start with allowing perhaps companies, perhaps some of the SOEs to add on top supplementary schemes. Perhaps you provide some incentives, tax incentives, or perhaps some co-contributions from the government for very small, low-income contributions. But you start with that kind of beginning point. You want to provide legal and tax certainty. Again, tax kind of preference is usually provided to these kind of schemes, so begin there. Have a robust supervisory set of oversight and regulatory regime from day one, because you don't want to just say, yes, it's fine for private pensions to start, and then have a really bad situation come about, and then have that kind of poison the whole the whole prospect for the industry going forward. So have that kind of oversight in place day one, but expect out of that regulatory regime and supervisory oversight an additional mandate of helping to grow this universe. You may eventually proceed to mandated supplementary schemes, but you may choose to do something like what was done in the UK a couple of years back, where they added auto-enrollment, where private employers had to put employees in supplementary schemes, but the employees had the ability to opt out if they chose not to participate. But because of just behavioral economics, what we all now know about human tendencies, most people didn't. So all of a sudden, participation in these kind of schemes has grown immensely in the UK over the last 10 years since they've implemented that. So that's another creative idea. I wanted to acknowledge a question from yesterday about informal sector schemes, because I think that would be very important here. The individual, I think, specifically asked about smallholder farmer schemes, and I think there's some great examples from around the region. Again, I'll say from the outset, this is hard to do. It's a challenge, but you now have some really good regional examples. One example the person mentioned was from Rwanda, where the Social Security scheme, the RSSB, has launched the Ejo Hesa scheme, and that is, they were very creative when they did it. They didn't just try to put in place their normal defined benefit promise, which requires years of steady contributions and consistency. That's not appropriate for informal sector folk who can only contribute once in a while. Instead, they created a defined contribution scheme, one that just becomes more of a long-term savings arrangement than anything else. And they made it appropriate so that many people now have joined that scheme. It's got millions of folks already involved. Ghana has some neat examples, again, because the person asked about smallholder farmers. Ghana has some schemes oriented toward the cocoa farmers. They have others for like artisans, where the Association of Artisans has become the intermediary that now kind of comes between the participants and the actual scheme itself, so that more education is enabled. So some great examples from around the region. Kenya has some good examples as well. So that would be something to think about. Growing long-term insurance, again, a worthy goal. Putting that robust regulatory regime in place is very important. It should be a trustworthy, stable regime. Policyholder interests need to be protected. And the government may choose to incentivize with some sort of tax preference for long-term insurance. A sound network of service providers and a financial infrastructure is important. And then finally, perhaps most importantly, public education and awareness needs to be built. Another thing to evaluate would again be some sort of microinsurance approach that involves likely a technology basis, whether or not that's mobile telephones or some other basis that you come up with. There's some great examples from around the region. So thank you for your patience, and now I guess I'll be joined by my fellow panel members.
Yeah, I understand we are running out of time. Lunch is approaching, so we'll make it very short and precise. First of all, I would like to thank Mr. Mark Davis, for this excellent insight. So I'll just throw the first question to Mark, and then I will only be asking one question for each participant, panelist, and then if the audience have any questions, we can accept because of time limitation. So, okay, thank you, Mark. So my question, it's this excellent insight, especially the one that I picked up is, especially the example that you went into the pension funds in Ethiopia, especially in terms of designing strategies. So the question that I wanted to ask is, in the context of Ethiopia, where we have a defined pension benefit schemes, and then also within the risk volatility space, we have inflation risk, persistent inflation in this country. But on the positive side, this is a young population. The pension horizon extends to 20 years on average. So in this context, also, in 2022, the pension funds, they have revised their regulations, and then they were allowed to design investment strategies. So one of the challenge is basically to design, a workable investment strategy. Maybe if you can comment on that, given that it's a defined pension benefit scheme, given that there is inflation risk, potential inflation risk in this country, of course, and then looking at the young age, 20 years average horizon, if you can comment on that. Thank you.
So for a pension scheme that's a defined benefit scheme, it actually becomes a little more straightforward as far as how to arrange the investment strategy, because unlike defined contribution schemes where you put the investment strategy sometimes in the hands of the participant, in the case of a defined benefit scheme, you have a governing board that's making decisions on investment. When you're faced with a young population, a lot of inflation risk, and a limited investment universe, it becomes challenging. And one of the things that typically becomes an approach here in this region is real estate, so property of some kind, and that's a good and a bad thing. It's bad because it's hard to make decisions about real estate investment that is done well. You need a strong board. You need a board that doesn't just think, well, I know what property we should buy. You need a board that's looking at it on a professional basis and making smart decisions about where the pension fund can invest for the long term. Because again, what you're focused on is protecting that group of young participants from inflation risk. It can be done, and I think it's a great kind of asset, but it should be complemented by other assets. Ideally, you can also do it with some level of external involvement. So using service providers that can take some of the hard work of, whether that's like rent collection or some of the things. I've seen some of the Social Security schemes in the regions are just like 2/3 of the organization is just doing the rent collection, the other kind of basic day-to-day kind of work that takes them away from maybe things that could be done more powerfully for the Social Security scheme. But there's a lot of other assets. I mean, if you have more access to listed equities, I mean, we've talked today about the IPO, we've talked today about the directive. To the degree that the IPO leads to more and more listed equities being made available, that's a very worthy investment universe for a young population. One that ideally is complemented with a good level of diversification, and one that can be for the long term. Another thing that's just very basic is longer tenor government bonds. So I understand that the scheme that exists today currently invests primarily in shorter term bonds, but you've got 20 and 30-year liabilities. So you do really want to figure out how does the government bond universe develop, and then how can you get the pension scheme involved in the longer end of whatever is being issued. So that's as short as I can make it.
Okay, thank you. Okay, my second question goes to Mr. Siongo. So staying in the same investment strategy, maybe a little bit extension on investment behavior as well, characteristics and investment behaviors of institutional and retail investors. And you can give us an example of, the Rwanda example, just to comment on this. Thank you.
No, thank you. In terms of investor preferences and behaviors of the retail market, I think the first thing I want to highlight is, retail investors, it's very unlikely you'll find two who are exactly the same. So in terms of their preferences and how they behave, they're quite diverse. Even looking at this very large room, I doubt there are two people here would be exactly the same in preferences. And a lot of it is driven by, what you've learned, your education, really what your current financial position is, your goals. And these are some of the factors that are driving sort of what investors want to invest in. And reflecting on the Rwandan capital markets, which are nascent and are still developing, are only 14 years old. Investors' initial preference, if I could generalize, is to identify with securities that they're familiar with. So a lot of investors are already saving in banks, in MFIs, in various saving products. Some have exposure to real estate. And if you look at these asset classes or these type of securities, if I could call them that, the returns are characterized by being fixed or predictable, and there is some element, at least from a layman perspective, that there is capital preservation. So I think, you know, for a lot of first-timers to capital markets, there's a natural inclination towards high-quality bonds. So these are bonds, you know, issued by big companies, by the government, given there's a sense of safety around that. But, you know, as investors become more knowledgeable, become aware of more securities, you see the appetite growing. Still, when it comes to fixed income securities, what you do see a lot with investors, retail investors, is you know, appetite for long-dated papers. And this is really due to the desire to have yield. So what's very interesting in the context of Rwanda is if you look at the trading of government papers or corporate bonds for that matter, most of the trading on the secondary market and the papers that have the highest subscription rates are on either side of the yield curve. So the 3-year paper is the shortest dated paper, so a lot of the short-term insurers, banks, they like that. But then you look at the 20-year, that's probably the most traded paper, and when they're offered the most subscribed, you know, and this is really driven by retail interest and, of course, pension funds, etc. And when we do have a 20-year reopening, that's the longest dated paper. You know, I see a lot of staff asking for overtime benefits due to the sheer number of applications that do come in. I think in terms of behavior, from a retail perspective, there are 3 things that I think characterize, we typically see. I think the first one is a lack of diversification. So a lot of retail investors, you know, when they find 1 or 2 things that work for them, you know, they tend to overload on these, if I could say that. So they may have 1 or 2 stocks if there's a stock exchange with multiple securities, and, you know, maybe just 1 or 2 bond papers. So you see a lot of concentration of securities. The second one is a high level of loss aversion. You know, so there's a lot of excitement when markets are going up. You know, track record gives people the sense that it's time to buy. When maybe it's a time to actually sell and reallocate your money to better valued assets. And when things are going down, you know, you tend to find retail investors are the first ones to panic sell when actually they should be buying more. And I think it goes to Mark's point that, you know, retail investors could be volatile, but they are extremely key from an economic growth and financial inclusion perspective. And then I think the last thing is, you know, retail investors have a lot of heuristics when making decisions. You know, they typically do not do a lot of research, and I think that's a key role that advisors, brokers, investment banks here have to play in terms of educating clients and ensuring that, you know, the securities that are sold are appropriate for their goals and their investor profile. So I think that's a broad overview in terms of investment preferences and behaviors of the retail market. Thank you.
Thank you. Siongo. So my next question goes to Leonard. It's on market dynamics. So in the context of market dynamics, especially the interplay between retail investors and institutional investors, how do you see the activities of retail investors affect strategies of institutional investors based on your experience?
Thank you. I think it actually works the other way around because of the way Mark has described that institutional investors in these markets are mostly pension funds, insurance companies, although we've started to see other specialized funds that come to market. They will go and raise capital. Yes, it could come from these institutions. And these investors follow a certain strategy. So, and they have these investment policies that they have to adhere to. So the interplay that we do see is that these investors are very active, and they tend to be involved right from structuring of transactions. I believe if that there was an active institutional investor in this market, you would have seen the transaction advisors talking to them even before they come to market, just to try to make sure that whatever they are putting to market is palatable to the investor base. So we see them as very critical in the fact that they tend to carry them in the retail investors, and that helps to maximize success of issuance. When you, I mean, Siongo has mentioned about the expectation of increase in value. I mean, retail investors, like we saw in Safaricom IPO, is that people actually borrowed money to invest. I'm not sure what's happening here. And then there was an oversubscription, and so that means they didn't get fully allotted, and then the share did not perform the way it did. So there was a bit of issues there in terms of meeting expectations. But then the issue was lucky because there were a couple of institutional investors. Yeah.
Thank you, Leonard. So my last question goes to Mr. Farai from IFC. So what can an organization such as IFC, I know you work at Treasury, IFC Treasury, so what can an organization such as IFC do to support investors' participation in both debt and equity issuances? You can look at both the institutional and retail investors' participation based on your experience in other markets.
Yeah, sure. No. Yeah, happy to take that question. And I think maybe just to provide some context to it, within IFC is a global issuer, right? So we issue bonds globally. I think annually we raise close to 15 billion from the debt capital markets, and we do this across different markets. And more recently, we've been issuing quite a lot in Africa, and often when we issue in Africa, we're the first international issuer in a domestic market. And I think there are several markets where I can list where we had that privilege of being the first issuer in a domestic market. That includes markets like Zambia, I think Rwanda as well, Nigeria, and there's so many markets where we have been in that unique position. And one thing we've realized is when it comes to attracting investors to participate in your issuances, there are certain core principles which you need to at least ensure are in place. So I think the first thing that any investor would look at before they can participate in any market is this market a safe place for me to be in, right? Before I put my money and I buy this bond off this market, or even before we as IFC come to market and issue, we spend a lot of time looking at the regulatory framework that's in place. So for us as IFC, it's so important that we create a regulatory environment that can support and protect both investors and issuers alike. And one of the things which we do within IFC is we try to support through capacity building. And one of those initiatives is what was mentioned yesterday by Mary, which is our IFC Milken program, which helps to train regulators in different markets. And I'm very happy to note that we do have some regulators from Ethiopia who have participated in this program. And what we often find is the next level of, once you've created that environment, then you have a supply question. Where are the issuers going to come from? And often what we see is the top tier issuers in a market are very reluctant to issue simply because they can access funding from banks already. And like we've already mentioned several times, coming to market is a rigorous process, it's an expensive process, and it requires a lot from the issuer themselves. So what you tend to see when you come to market is the first issuers to come to market tend to be your tier 2, tier 3 kind of institutions, and never the blue chip companies. And what that creates is a conundrum for investors, because they are often exposed to the more risky issuers. And for us as IFC, it then becomes a question to say, how do we help to de-risk these issuers? So what we do, we have several ways in which we do it, but one of the ways we do it is we provide IFC guarantees, and we put our AAA rating behind it and guarantee an issuer, and that helps to de-risk an issuance and allows investors to participate. And you'll find often, like Siongo mentioned, in the case of retail investors, capital preservation is a major motivation when they invest, and knowing that this issuance has been guaranteed by an issuer like IFC is really important. The third thing we then see is, after we've managed to de-risk this issuance, how do we bring in more investors to participate in this issuance alongside us? And that really comes down to a mobilization question. How can we mobilize investors to participate in these issuances? And this is when we try to pretty much anchor transactions. So we would come in and support a transaction and put our name behind it, and it would be a public announcement that IFC is participating in that bond issuance as well. And for an investor who may have not done their research, like Siongo said, they would then realize that, well, if IFC is participating in this transaction, for certain IFC has done the research, they've done their due diligence, and then that helps to that investor to also participate. And another thing we do, like when we're issuing these bonds in these different markets, is we're actually doing demonstration transactions for other future issuers to come to market, because we are saying, even with our AAA rating and being a recognized issuer globally, we are in a domestic market and issuing. That means that if you are also in that market, you can come to market and also issue. So that then helps to mobilize in issuers alike, but also through anchoring, we are mobilizing investors to also participate in these issuances. And then lastly, if I put on my hat as a issuer, I think one of the key things, if you are looking to issue in any market and you're really trying to get participation from investors, is to really understand your investors, right? So like Siongo said, retail investors and what their expectations are from the market is very different from what you'd see from institutional investors. So for example, if an investor is participating in an IFC bond issuance, typically IFC, given our rating, it's a very low risk investment, and therefore the return is not necessarily going to be the highest. So what investors are looking for when they participate in our transactions, especially the institutional investors, is really capital optimization, because they get capital relief because we have zero risk weighting. We see a need to kind of diversify their portfolios and bring in a new asset class such as ours. So really understanding your investors, if you're an issuer, working closely with your advisors, and trying to find the right investors who are the right fit for who you are as an issuer is very key. In closing, I'll say that's what we do as IFC, but it's not necessarily really only IFC who has a role to play. And if you'll see on what I've explained, every single member of this ecosystem has a role to play. And if we're to bring in more investors, both on the debt and equity side, it's really a joint effort from everyone. Thank you.
Thank you so much. What an excellent panel of experts. But unfortunately, because of time constraints, we may have to finish our session right here. I'm sorry, we are not accepting any more questions from the public. But if you have any questions, you can always send it to ECMA Communications. And then our panel of experts are our partners in this capital market development journey. So they are always available to support and engage in future programs. So by this, I will have to finish and hand the mic to Saron. But big round of applause to our panelists.